Everybody. Hopefully everyone can hear me okay. All right, so I'm Garrett Smallwood. I'm the CEO of WAG, if you couldn't tell, which is the ultimate pet services marketplace. Think about things like dog walking, boarding, sitting, etc. And today, I'm going to talk a little about what I believe is the #1 startup killer, which is, surprise, surprise, hubris. So hubris, it's not a word I actually heard a lot in Silicon Valley before, I would say, leading a larger company. But I love this quote from the CEO of Okta, Frederick, who said, "Many startups experienced successful exits in 2013. Others crumbled to the ground. A common cause for those failures exhibiting hubris. It's a big mistake that startups and established companies alike make. It lulls them into cockiness, complacency, and a sense of invincibility, and causes them to lose sight of what matters most, making customers successful." And I'm going to talk a little bit about what I believe are the ultimate kind of hubris lessons after being at WAG for the last few years. For some context, those who don't know, WAG has raised almost $400 million in venture capital since starting. We've raised $300 million from, oh, sorry, hang on. I think I have some echo. 1 second. Sorry. I don't know why I have echo. Maybe that's better. We've raised almost $400 million from investors, including SoftBank and let me see, I'm getting text. Headcount isn't an accomplishment and should never be conflated with growth. I go to a lot of I have a lot of phone calls, or I used to have dinners and lunches and coffees where people be like, how's your company doing? You'd be like, oh, we're 500 people now, which is probably one of my favorite, hilarious kind of, I don't know if that's good or bad. I don't know if a lot of people's good. I think we naturally conflate that a lot of people's naturally good. That isn't necessarily true. Like if you look at Amazon, what really matters is kind of where you're spending your money. Like Amazon spends almost $23 billion a year on R&D. And, if you look at Walmart's recent income statements, they don't even share their R&D expenses. So I really think it really depends on where you're prioritizing headcount. Chris from StubHub recently gave a talk who talked about kind of operational efficiency. Roger Lee, I think. And, if you have 500 people in ops and 50 in R&D, it's probably a problem. #7 is, I think, funding PR. Everyone wants to be on TechCrunch. Everyone really wants, that announcement of you raised $3, $5, $10, $20 million. But I really think that's more for you. Like personally, you might feel good about that. Your team probably feels pretty good about that. Maybe future hires, although it's kind of weird signaling, right? Like if the only reason people are joining you is because you raised funding, like shouldn't they believe in the business or the way you're solving problems or the team? And it's kind of for your investors, but it's really not for your customers. Like don't try to conflate that, your customers are reading TechCrunch and now care that you've raised $10 million. There's probably some rare instances where this isn't true. Maybe companies that are dealing with big public companies who need to have faith that the software they're buying is going to be around for a long time. But generally, I don't think this is true for consumer marketplaces. And probably the most notable of this was this WeWork. I think I saw every week a new announcement of WeWork funding and raising money. One thing I like to remind early founders is that every dollar you spend actually costs you equity. Like you sold equity to investors and now you're selling and now you're giving away that money or using that money to grow your business. But you've had to sell your equity to do that. So in theory, then every dollar you spend is literally just you giving away your company. So when you think about that big splashy brand agency or big TV commercials or marketing, spending money on Facebook or Google or rent, that's all your equity you're giving away. So if you raise 20 at 100, every 100K you're spending costs you 0.1% of your company. And I generally don't think a lot of these things are worth it. If you look at the startups that ran Super Bowl ads in 2000, I think Last Minute Travel was a Pete Flynn company. I think they ended up doing pretty well. We've all heard of pets.com, epidemic.com, computer.com. A lot of these did not go well. Last Minute Travel, I think, made it. Auto Trader made it. But most of them spent a lot of money and didn't get great ROI. I think it's important to think that they actually spent their equity to make those bets. Maybe equity was worth less back then. I don't know. Number 5, there's no such thing as an overnight success. There's so many of these like overnight success stories. Like, look at this great company. And then you look at like when they founded, and it was like 2011 or 2014. In general, it looks like it takes about 5 to 7 years for companies to innovate and actually bear fruit. Bear fruit could be, get to a certain revenue, get to profitability. For certain marketplaces, maybe it's get nationwide or expand internationally. But there's really like no silver bullet. And I think a lot of companies and people are looking for silver bullets, things that are just going to make them work tomorrow. And what you end up finding is it's probably like 5 changes every day for 5 years that get you there, not 1 change a week that makes it work. And if you look at like the best example of this is probably Slack. Like, Tiny Speck was the pre-Slack Slack. I think it was backed by Andreessen. It was a gaming platform. They built this web chat to help themselves build faster and innovate and communicate. And that's actually what they ended up pivoting into, was then Slack. So Slack was not like an overnight success. It took 5 years to kind of get to Slack being released and being out to the public, and growth then working via the natural kind of network effect that it has for it to drive value. So I think great example. I think I heard a lot of people try to talk about Slack being this, look how quickly they pivoted. It's just great. Like, it took 5 years. That's a really long time. And the way they made it was like by being sustainable, by being really thoughtful and just building. Number 4, I really do think most meetings are a waste. Mark Cuban says, the only way you're going to get me for a meeting is if you're writing me a check. I'm sure y'all have heard of like the Jeff Bezos meeting structure, or David Clark, where to hold meetings is really just to read. Like, every single person that attends a meeting has to write a 6-page kind of why, what, how. And that's what you are reading and talking about. And Elon Musk, I'm not sure his management style is the absolute best, but seems to be working, called excessive meetings a blight on large companies. And when you talk to people, like, they're proud of how busy their day is and how many meetings they're in or how many discussions they're having, in the previously open office before COVID. And I think that like that's actually really negative, right? Like, when are people then getting their work done? If you're in meetings from 11 a.m. to 3 p.m., like, when are you actually building and innovating? Like, it doesn't really, I don't get it. This HBS, like, we surveyed 182 senior managers in a range of industries. 65% of people said meetings keep them from completing their own work. 71% said meetings are unproductive and inefficient. 64% said meetings come at the expense of deep thinking, and 62% said meetings miss opportunities. In general, I think that meetings really hit the people building the most, right? Like, if you're a manager, a mid-manager, a senior manager, like, you're not as affected because you probably have passed off a lot of your work, which is like the blight of mid-management, which is a separate discussion. But meetings like really affect the people who have to get work done every day. One of the things I think is constantly overlooked in the way of Hubris is improving cost efficiencies. Like, you hear so many entrepreneurs and founders, I think really in the previous kind of growth at all costs era, say like, oh, we'll make it better later. Like, just add bodies to customer service, add bodies to account management, add bodies to customer success, add bodies to QA, whatever it is. But like, those cost efficiencies are costing you. They're costing you equity in theory, which is a previous kind of learning. And now they're costing you, margin, which is then your ability to continue to invest in the marketplace and to grow the business. Like, growth spreads across all fixed costs, right? Like sales, like reducing your cost per unit, make it possible to reduce price. And when you get price down, we generally know what happens is it drives more customers. And that's like the beauty of the Amazon flywheel, is they solve really hard problems, which are a lot of like operational problems. And their ability to like increase customer visits via this flywheel really comes from being operationally excellent and reducing costs every day, like every 0.1%. They attract sellers, they expand their ability to distribute, they grow the revenues and alongside fixed costs, and they lower prices. And they just keep doing that. They become relentless. And I wonder how many marketplaces exist that if they were N% more efficient and were able to drive down price by Y, like how much better they would be for consumers, like how much better they'd be able to compete. And I think that, a lot of marketplaces when they first launch try to compete on price by comparing themselves to, their premium products or things like that. But really what you end up seeing is that you have to continue to drive the demand. The demand as it scales, usually looks for different pricing. Like you go from the people who are most willing to spend the most to the people who are most willing to spend the least. And you have to be able to get all of them. Number 2 for hubris lessons is you should be proud of being frugal. Frugal is a constraint that drives innovation. My parents used to say there's nothing to be proud about in paying full price, which, when you think about it, there's a lot of ways to extrapolate that out. I don't feel this way on people. I think people should be excluded from being frugal. Like really great people, you should pay up for in equity and salary and everything else. But when everything's up for negotiation, whether it's a vendor, an office space, marketing, even your term sheets, like everything is up for discussion. And I really do think that, asking and pushing down price, it compounds. Like there were so many instances where people, it's only $500 a month. It's only $1,000 a month. Like those little onlys add up pretty quickly. And a lot of people just spend too much time optimizing the big purchases, AWS or, the marketing, the PPC, the Facebook, but it's all the little things that really kill you. So there's really nothing to be proud about in paying full price. There's this great tweet from Modest Proposal comparing Expedia to Booking, and generally like their personnel as a percentage of revenue. Expedia, I love this. Expedia has a grand new HQ, which we all know what they say about new HQs, generally not a good sign. Multiple private jets. They pay out substantially higher SBC and did not have reputation as killer operators. Conversely, Booking, which is like less than half personnel percent of revenue, Booking a Spartan HQ office, very basic. Jeff Boyd flies coach from like the most non-name brand, flights which don't have commercial relationships, and operates with like military-like precision. Like, who would you rather bet on? Like, this is like the ultimate. There's almost like a movie to be made here, right? Like, would you rather bet on the company that has this fancy brand new HQ, the private jets? They're paying out really high stock bonuses, or would you rather bet on the person who's flying coach and staying in a pretty normal office? I mean, I know where my money is. And number 1 with hubris is you can accomplish a lot with a good reputation. Jeff Bezos says it best. I think your brand is what other people say about you when you're not in the room. And this is like, ultimately, this kind of gets you everything else, right? This gets you your ability to have difficult conversations and be frugal and be really thoughtful. I was lucky to spend my early career 5 years at Home Depot. Home Depot bought a marketplace I worked at called Red Beacons, a home services marketplace. And I worked for Frank Blake, who is the CEO of Home Depot and probably the most kind of humble, empathetic, charismatic leader I've ever worked for. And he had this inverted pyramid, which kind of always stuck with me. And if you look at the pyramid, it's customers at the top, the frontline associates, so the Home Depot retail associates, there's about 450,000 of them. Then field support, which are the corporate, and then corporate support, and then the CEO at the bottom. And I think too many companies, there's like this flashy lifestyle of being a founder or a CEO or an executive, and you think about yourselves like the other way, like you're at the top of the pyramid. And I think Frank really nailed it. Like the inverted pyramid is the way to operate your business, and then everything kind of falls through, right? Like if you're investing in the customers, you're lowering prices, you're being frugal, you're being thoughtful. If you're investing in the associates, it all kind of like pushes down. I think when you reverse that pyramid, you get in really big problems. And look at Expedia. And Home Depot's done quite well. I think when we joined, the price was like less than $100. Actually, it was like $37. This is right after 2012. Now it's $235 a share. And finally, like the ultimate hubris is that it's okay to fly under the radar. Like there's a lot of really great businesses, like really great, even public companies that aren't on TechCrunch or the Wall Street Journal or New York Times. They probably don't want to be, honestly. Like they're probably enjoying just operating how they're operating. And they're still like really great businesses. And that's okay. One of my favorites is Chegg. Like Chegg in 2016 was a $7 a share stock. I think it was 80% rental business for books. And in the last 3 or 4 years, they've diversified their business. They've done some just incredible stuff. If you look at their product portfolio now, it's expansive, it's diversified, it's pretty operationally efficient, great business. And they have almost $8 billion market cap. I think they're now like a hot stock. Another one I really like is Etsy. Etsy's done exceptionally well. Been through some interesting times as well in 2016. But the same thing here, like they've really focused on operational excellence, putting the customer first, listening to customer in terms of NPS. They've figured out payments and communications, and they've integrated with a bunch of useful tools. So Etsy is a phenomenal kind of rocket ship. We don't hear about a lot, but like it's up and to the right over the last 3 years. And finally, Blackline is a bit more slow and steady, but again, like really thoughtfully run business. If you haven't looked at it, really rigorous in terms of how they operate. And again, like a kind of a sleeper. Like I can't remember the last time I saw on the Wall Street Journal a Blackline feature. That's it. I will. I think I nailed the timing here. I will pass it to the Q&A. Yeah, so Gabriel says 2 questions. Looking 5 years in the future, what's next for marketplaces? What trends are you most excited about? So that one. So first, I think it seems like we're in marketplace 3.0 wave, which is we think about it at WAG as really like how do you enable new supply? I think over the last 5 years of marketplaces, we've been really focused on bringing supply onto the marketplace, so differentiated supply, which then drives differentiated demand. Demand that previously didn't have a way to find this supply. And now it feels like what you're going to find is that there's a lot of marketplaces that are enabling supply to do new things. So, Patreon is a really interesting, marketplace network effect where they're enabling, creators to make money and build their business in a way they probably couldn't before, which is like fundamentally new, but those creators existed before. So it's really like differentiation of the supply, which I think would be really interesting. Cameo is probably another good example, but that again, that's just like an untapped marketplace. Cameos, for those who don't know, celebrities, you can request celebrities say and do things for a set fee. But again, that's more like supply wasn't there. I really think the future is going to be education and kind of differentiation of supply in the new world. And it did take WAG 5 to 7 years. We're now almost 5 years old. I would say that we need to continue to innovate, but it took us like 5 years to launch kind of this on-demand dog walking and pet service business across 50 states and 4,600 cities, and to get to hundreds of millions of gross bookings. Like it was not overnight, and it seemed really fast. But when you look at the 5-year trajectory, it was definitely like up and to the right. Took some time. Was not an overnight success at all. Asim says, how do you think about creating the culture of the company? What helps define the culture in the early days? There's a great quote from Jeff Bezos, I think, that stuck with me, which was, you want to find people that want to help build the rocket ship, not be on the rocket ship. And I think that's really important. Like there's another one that was really interesting, which I think James Courier told me from NFX, was there are too many, you can figure out how Silicon Valley is going to do when you look at how many kids are graduating from HBS with an MBA, and then how many are going to finance versus tech. And if more go to tech, we have a problem. And what he means by that, or what I think he means by that, is that people should go to tech because they think it's the right thing to do for them, not because it's where the money is. And people should join companies because they believe fundamentally in the value proposition, the team, what we're solving for. They shouldn't join because Andreessen invested $100 million. And so I think ultimately the culture and what you're looking for is people that fundamentally believe in the business and what you're doing. They don't believe in like the investors or just like this is a hot space. Like the amount of people that went to mobility startups, I think in the last couple of years will just like, it's going to be, a huge learning. Roberto says, one question: when trying to build a marketplace where you have a consumers and providers, what is the best way to start building up some tips? Yeah, chicken and egg problem, right? Like I think it really depends on the marketplace, but generally all that matters is demand. Like you can always get the supply if there's enough demand. You can't always get demand if there's enough supply. So I really think that really all that matters is establishing proprietary demand, having a unique acquisition strategy that allows you to retain and acquire customers. It's really like the number one priority. You can always get the supply later. Cool. Well, I appreciate the time, everybody. I'm Garrett.s@wagwalking with questions. Garrett Smallwood on LinkedIn. And again, thanks for listening. I hope that the recording we can fix, because I think my voice was a little bonked up in the beginning there.